Hi guys. Okay, we're going to go ahead and take a look here at the slides from chapter 16. And we're still focusing on stockholders' equity in this chapter, but now we're starting to move ourselves more towards calculating earnings per share information. And what the accounting standards require is that we not only report our primary earnings per share, we're also going to have to consider potential dilution of our earnings per share. Dilution of earnings per share is a fancy way of saying that our earnings per share will decrease. And so when we look at this, we're going to be considering things that would be potentially diluted, would potentially decrease our earnings per share. And the accounting standards require that an entity report what the diluted earnings per share would be. The idea there being that a potential investor or current shareholder would want to see what would happen if shares that are not yet common shares were somehow converted into those common shares. And that's going to focus on bonds that are convertible into common shares, preferred stock that could be converted into common shares. And for once, as accountants, we get to use our imagination. We get to pretend. What would happen if these shares were actually converted? And we're going to see that there's some very specific rules as to how that's done. This is probably an area of accounting that gets a little bit tedious, a little bit rules-based for us. So you're going to have to practice with understanding how you kind of jump through the hoops that the standards have laid out for us here in making these determinations. The other thing we're going to look at a little bit in this chapter is going to be dealing with stock compensation and how we would account for options that are often provided to employees and how those could be dilutive, and frankly how those would generate a compensation expense for us, something that was somewhat controversial some time back, and I'll talk a little bit about that when we get to that subject. So those are the main things. Chapter is, I wouldn't call it hard. It's a matter of repetition to get comfortable with this material, and it's just not something that really gets deep into your DNA as an accountant. It's something you always have to kind of think back and think through. What are the rules here? How will I handle this? Some things in accounting are like that. A lot of what we do is tied to conceptual framework, but every now and then we get something that's very rules oriented like this is, and we just have to spend the time with it to get comfortable with it. So don't freak out too much if you're feeling a little uneasy on some of this material. I think that's a natural way to react to it because it's not leveraging off of our understanding of conceptual framework and this appreciation of why we do a lot of the things that we're developing in this class. We can't rely on that, unfortunately, for this, and have to get to the rules part of our brain and really try to exercise that and see if we can get comfortable with these procedures. Okay, so with that as an introduction, as I've mentioned, we'll talk about accounting for the conversion of stock, either convertible bonds or convertible preferred shares into common shares. I didn't mention in the introduction, there's also warrants for stock. And what the warrants do is they're typically attached to something like debt. And if the warrants can trade separately from the debt, in other words, I can take the warrants and I can trade them separately, then upon the issuance of the debt, the bond, I will have to account separately for those warrants. And we'll see that process a little bit as well. As I've mentioned, compensation plans involving stock. We're going to focus primarily on stock options here in the Northern California part of California. San Francisco Bay Area is probably the biggest part of the country. I think it is the biggest part. I'm going to go out on a limb and say affirmatively that it is the biggest part of the country that attracts venture capital. And a lot of times as these companies are coming up, and especially technology companies are coming up, rather than have to pay a high cash salary to their employees, they offer stock options, and those stock options have value upon the award. And when that happens, the company then is going to have to recognize some compensation expense, and we'll talk a little bit about that. And then again, as I've said, basic earnings per share, and that's easy. But then when you get to diluted earnings per share, yeah, that gets a little bit, again, rules-based, and so we're going to have to get comfortable with those rules to help us to understand this stuff. Okay, good. So let's just go ahead and first take a look at what happens when we have convertible securities. Okay, and so we're going to focus first on convertible, and they say convertible securities just to be a little more generic, but really we're going to focus on convertible bonds. We're going to focus on convertible preferred stock, and then we'll talk about stock options. And again, when we talk about the stock options, it's not so much that they're convertible as much as we're going to see that they are going to generate a compensation expense. So they're liability or equity, this question asks, and you know that because we're in the stockholders' equity section. I mean, the bond part of the bonds that can be converted into stock is debt, and then it transforms like a butterfly into equity if indeed the bondholders do convert those to stock. Okay, that's pretty obvious. So let's just go ahead and take a look first at the convertible debt. Okay, and so recording convertible bonds follow the method used to record straight debt issues with any discount or premium amortized over the term of the debt. So when you first issue a convertible bond, you treat it like any other bond. But what will happen is the bond will typically issue for more than face. And so generally, even though they talk about a potential for a discount, generally convertible bonds issue at a premium. And you're just going to simply go ahead and record that as though it was any other bond. It'll issue at more than face, there'll be a premium. And then where the real thing that we're going to be adding to our understanding at this point is what happens at conversion. Okay, so let's just focus on that. In fact, let me just quickly, so I issue a convertible bond. I'm just going to make up an example on the fly here, guys. I issue convertible bond, and I issue convertible bond, and the price of that convertible bond is, say, $1,089,105. Don't ask me why that number's in my head, but it is. Okay, so if I issue it for that price, and let's say that's the issue price, okay, and then I go ahead and I have a face on that bond, coupon amount on that bond, right, or whatever. The face of the bond is $1 million. And so what happens when I issue that bond, right, I will obviously debit cash, 1,089,105, and that number's in my head for some reason. Okay, and then I'm going to go ahead and I'm going to credit, what are we in, chapter 14 on this example now? Okay, I'm going to credit bond payable for the full $1 million, of course. And then I'm going to credit the premium, and I'm going to credit the premium for $89,105 because it issued at more than face. And as I said, with convertible bonds, most of the time they issue it more than face because people like the conversion feature. But notice I'm not doing any specialized accounting to deal with the conversion feature. I don't do that until, I don't deal with the conversion feature until the bond is actually converted into in most cases, into the common stock. So when the debt holder converts the debt to equity, the issuing company recognizes no gain or loss upon conversion. Okay, all we're going to do is take the bonds off the books at whatever the carrying amount of the bond is at that point in time. We're going to go ahead and credit the common stock at par. So we take the bonds off the book. There'll be a debit to the bond payable. Since there's a premium, there'll be a debit to the premium, okay, to take that off the books. And then we will go ahead and we will credit the common stock at par. Any difference between the carrying amount of the bonds at that point in time, which of course the carrying amount would be face plus any unamortized premium, is going to go to additional paid-in capital. That's it. I mean, it's actually not that difficult to deal with here. Okay, I think we can rely on our accounting instincts here for this. Okay, so let's just take a look at this example. Okay, and what I want to do is I just want to remind you, as I just did a minute ago, they issued 1,000 bonds. Okay, and I'm just going to assume that they issued these bonds, you know, and then they immediately converted them into stock, which is probably unrealistic. But let's just go ahead and pretend that they issued the bonds for cash. Since the bond is at a premium, it would have been $1,050 cash that came in. They would have credited, of course, the bond payable at face for $1,000. And they would have gone ahead and, of course, to make this journal entry balance, they would have had to credit the premium for what, $50 here? Okay. Now, I'm assuming the bond got converted the next day. That's unrealistic. It's unrealistic that somebody sits there, buys a bond, and then the next day converts it to stock. They're probably going to sit back and watch the market and whatnot for a while, and then decide whether or not they want to convert it into the stock, right? So you would always have to be careful that if I give you a question on your exam, and I think we have some in the practice midterm that's posted, where some time elapses and there is an amortization period there of the premium, you would have to first, as accountant, amortize the premium up to date, take the related interest expense up to date, pay out any accrued interest at that point in time. Now you have the correct carrying value for the bond, and then you can begin at this point to basically take the bonds off the books. Okay, so in this case, they're doing it the next day. And so I'm going to go ahead and they're going to convert the bonds into, and each, the $1,000 bond can be converted into 10 shares of common stock. Okay, so they're going to go ahead and they're going to convert those bonds, and they're going to convert them into 10 shares. 10 shares times what? Times $10 per share. Not if you can turn back time share, but shares of stock. 10 shares times the $10 per share. That means that what? We're going to have to issue the common stock at par. Okay. Since we're issuing the common stock now to you, we're going to take the bond back from you. So since the bond is coming back, when I say take it back from you, I'm assuming you're the investor there. I'm the company. I'm going to issue the shares. I'm going to take the bond back. Okay, so you can go ahead and issue the shares at par. That might be the first thing you figure out. Then what? Then you're going to take the bonds off the books now at their original issue price, right? And then 3, take off any unamortized premium at that point. And again, if we're doing that the next day, same day, then there wouldn't, the unamortized premium would be the premium that it was at the date of issue. If not, you'd have to sit there and amortize that premium and accrue up any interest that was due up to that point, okay? And then I'm putting these numbers on here because then the paid-in capital in excess of par for the common stock is this the difference between the carrying value of the bonds and the par value of the stock that you just issued, okay? Okay, good. And you can see some different reasons that we would go ahead and want to encourage the conversion, and probably the most, frequent reason, although I haven't done any empirical study on this, but I'm guessing that if interest rates drop, we have a high interest rate bond out there and interest rate starts to plummet, we probably would like to convert that from an interest paying security to a to an equity security, common stock in this example. But of course, the investor is going to say, well, hang on a minute, I'm not giving you the bond, it's paying me a nice interest rate. So we may have to include a sweetener in there, and the sweetener is basically going to be some additional cash. So we say, hey, you don't want to give up that bond, and we wave some cash under them, and then they say, okay, here, take the bond, right? Well, that sweetener is going to be treated as an expense because it does really relate to a transaction that happens in this period, and there is no more future economic benefit under the definition of an asset that would cause that to be recognized as an asset when we pay that sweetener, so it is simply expensed. Okay, that's the rule for FASB there. Okay, so when you take a look at that sweetener in this example, all it was here was we had the bond and we issued it at par value, so they don't deal with a premium here, but we did go ahead and give them this sweetener here, this additional cash. And so we would go ahead and I got to get my cash down there. I'm just looking at that journal entry saying something's missing. We have to go ahead and get them some additional cash to sweeten the deal, and that is expensed. Okay, just remember, if you have a sweetener, you have to expense that. Okay, good. Let's go ahead then and let's take a look at what happens now if we have a retirement of debt. And they say retirement of convertible debt here, as though convertible debt upon retirement would be treated any differently than the non-convertible debt that could be retired before maturity. It's the same deal that we saw in Chapter 14 for non-convertible debt. You just simply calculate the gain or loss. How much cash came in, and remember, often those questions we said, well, they retired them at 105. You take the face times 105. That's the cash you have to pay out. That versus what? Versus the carrying value of the bond. And we said back in Chapter 14, carrying value of the bond is the face minus the unamortized discount, or the face plus the premium. I guess for convertible debt, it's going to be face plus the premium. And if the amount of cash that you paid is more than the carrying value of the debt, that's a loss. If the cash that you pay is less than the carrying value of the debt, that's a gain. Okay, so nothing different there for convertible debt as how you treat it. You don't have to siphon off some of that to equity or something. It's entirely the same way you would have treated a non-convertible debt, the way we talked about in Chapter 14. Okay, good. Now we come over and we start to talk about convertible preferred stock. And we will not be recognizing gain or loss again here, as we just convert this equity security preferred stock into another equity security, the common stock. There's really no gains or losses calculated on conversion of a security from one category to another. Preferred equity to common, debt to equity conversion, we don't recognize gains or losses on that. Okay. Now, sometimes convertible stock will, preferred stock will be, the guarantees that come along with those preferences are enough that, and beyond really the scope of this class, but they're just letting you know here, and I don't want to completely ignore this, that there could be a situation where under certain criteria, they are saying that this preferred stock is actually a liability, and you put it in the liability section instead of the stockholders' equity section. But we're not going to deal with anything like that. We're just dealing with the simple case here. It's a fairly simple case. I have a common stock. I have a preferred stock, and I'm going to convert it to a common stock. How would I do that? Okay. Now they tell us company uses the book value method. There is out there the market value method, but US GAAP does not accept the market value method. So we're going to just leave our study with the GAAP method, which is called the book value method. Book value method, no gain or loss. So in anything we look at in this class, if I give you a question on your exam and we're talking about converting a debt security to an equity security, one class of equity to another class of equity, probably preferred to common, there's no gain or loss. So I may ask you the easiest question in the world on your exam. Calculate the gain or loss upon conversion. Answer is going to be 0. You will look for the 0 answer in that choice and move on to a more challenging question for you. Okay? All right, good. Okay, so let's go ahead and take a look at this example where we have a company that is going ahead and they are going to convert their preferred stock into common shares. Okay, so I just want to go ahead, just check my system here, make sure I'm recording. Nothing worse than thinking you're recording and then you're not, right? Okay, so let's just go ahead and let's take a look at this particular example. Okay, and I'm going to go ahead and advance the journal entry here, because what I want to do is put some dates on this, because I think it helps a little bit if we have some dates. So let's say that on 3/1/2021, whatever, the year is not that important, they convert this preferred stock into common stock, which is what we're considering here, right? And then let's pretend that on 1/1/2021, okay, we went ahead and we had issued, right, just kind of going into a time machine, we had issued this preferred stock, and let's just see what they tell us about it. It was 1,000 shares right here, okay, not there, that's the common stock. 1,000 shares of preferred stock at a par value of $1 was originally issued, and they say for a $200 premium, meaning it was issued for more than par. So if that's the case, then they would have at 1/1/21 when they issued, right, they would have debited cash, $1,200, credited the preferred stock, and I'm going to abbreviate that PS, okay, at 1,000, and then they would have gone ahead and credited this APIC here for $200 APIC, of course, preferred stock, right, for the $200 because they issued it for more than the par. They called that a premium, but that's basically additional paid-in capital, okay? Then they're going to go ahead and convert these, and again, I made up the date on March 1st, into common shares, okay? So what's going to happen? Well, the first thing we're going to do is basically reverse out the issuance entry, the preferred stock, because they're converting that to common stock. Then we're going to go ahead and do the part of the journal entry that relates to the issuance of the common stock, 1,000 shares, $2 par. We have to credit the common stock for 2,000. We still need what? $800 to make this journal entry balance, $800. So in this case, we need a debit, and that debit goes to retain earnings. What they're saying is, look, just looking at it on a book value basis, we issued to you more book value from the company than what you gave us. You only gave us $1,200 worth of book value. We gave you $2,000 worth of book value. That means we've distributed and it's kind of, they don't call it a dividend, but it's like distributing a dividend to you. We gave you what? An $800 dividend. That comes out of retained earnings because we gave you more book value than you gave to us. Okay? Now, what happens? If, and it could go the other way, let's say they basically gave us the preferred stock, and the preferred stock had a higher book value than the par value of the common shares. Well, then we would need what? A credit to make this journal entry balance, and that credit would be additional paid-in capital in excess of par for the common stock. Okay, so it goes one way or the other. In this case, since we needed a debit to make this journal entry balance when we issued the common stock at par, difference went to retain earnings. If we were sitting there and we were dealing with the preferred stock had a higher value than the par value of the common stock, then we would go ahead and credit a PIK common stock. Okay? All right, good. So that's what's happening in those two examples where we're converting bonds, in one case preferred stock, in the other case to common stock. Now, in both of those cases, it was contemplated that the holder of the bond, the holder of the preferred stock, had to give up that instrument in order to get the common stock. Well, sometimes they will have warrants that are attached to the instrument, say the bond. And these warrants allow the shareholders to acquire additional shares of common stock. Now, if the warrants are not detachable from the, say, bond, then under that scenario, they have to give up the whole thing anyway, and it's treated just the way we saw a convertible bond. If the warrants aren't detachable, they can't come off of the bond, then they have to give me the whole instrument anyway. It's the same thing we saw for the conversion of the preferred, of the bond to the common stock. But in some cases, the warrants can be torn off. Okay, and I tore these off of this piece of paper. They can be torn off and they can be traded separately. Well, if that's the case, then the accounting standards say to us, well, that means these warrants have a separate value. They have a separate value, and if they have a separate value, you're going to have to assign some of the issuance price on that bond. Some goes to the bonds, some's going to have to go to the warrants. And the bond, as we know, is a debt instrument. The warrants are treated as an equity instrument. So part of that issue price affects my liability section of my balance sheet. The other part is going to, the warrants part is going to affect the equity section. Okay, so let's just go ahead and let's take a look at this. And we have different reasons that an entity might issue warrants, and we talk about this idea of making them more attractive to give some of our shareholders preemptive rights. Guys, preemptive rights are probably for people we don't know. Okay, these are people who own huge shares, huge proportion of the shares of the corporation, and they want to make sure that somebody else doesn't come away and take away their level of control and influence over the entity. So they say, hey, I have these warrants that allow me to acquire any shares before they are sold to somebody else. Maybe, you're in a situation where you're the, younger executive, and you see some folk getting a little long in the tooth, and you've got all these talent that you're bringing, and you say, I'll tell you what, I'll take back stock rights as part of my compensation, but I want to have preemptive rights associated with that in the form of warrants, right? So what are you doing? You're waiting for these folks to sail off into the sunset, and so that over time you become the primary shareholder. Apparently, that was how, and I guess finally my shirt that somebody commented on, because I'm always wearing this Raiders shirt these days, that was supposedly how the owner of the Raiders, who's now passed, but that was supposedly using preemptive rights, how he seized control of the Raiders way back when. So, these sort of things are typically, though, high rollers that are dealing with these preemptive rights, and those could be provided through warrants. Okay. Now, when we have these warrants, what happens is there are two methods that we can use to account for the warrants. One is the proportional method. The other is called the incremental method. I am not going to bother you much with that incremental method. I do have the slides in there for it. We're going to focus right here. Proportional method, to me, is more common and just makes more sense for us, is a little more logical for us. Okay. Now, the way our slides are presenting this proportional method, okay, they're basically going to show us a long example here in a second. And I'm going to jump to the solution, and then we can go back and see where some of the information from the example came from. Actually, we'll read through the example and then we'll look at the solution. Then we'll go back to the example again just to refresh our memory, I guess. But anyway, basically with the proportional method, here's what happens. There is an amount of cash that will come in on this issuance of this bond with these little pieces of paper, the detachable warrants. Okay, so we have this amount of cash that comes in, and our job is going to be to figure out, well, how much of that cash should go to the warrants, how much should go to the bonds. Okay, and it's really going to be predicated on the market value of the relative instruments. The market value of the bond, the market value of the warrants under the proportional method will determine how much should go to the bonds, how much should go to the warrants. Okay? Okay, good. So let's take a look at this illustration and let's just read it. Assume that AT&T's bonds have a par value of 1,000 sold for 99. Now, what does that mean? Well, that means they're selling for less than face. This is telling me that whatever I end up attributing to be the market value of the bonds, it's going to be less than the face of the issue. Okay, so these bonds are going to issue at a discount. Okay, what happens? The market price of the warrants at the time was $30. Okay, good. They come right out and they're telling me the market value of the bonds, the market value of the warrants. That's how I'm going to allocate that cash between the two instruments. Okay. Now we come over and they could have done without a lot of this, but let's just look right here. The price paid for $10,000 bonds with warrants attached was par of 10 million. Okay. So what happens? They're telling me that the cash that I got is 10 million. They're telling me that it's what, 10,000 bonds, 10,000 times 1,000. That's the $1 million that came in. They could have done a better job, frankly, to tell me that each bond carried one warrant. They don't say that. Bonds could carry more than one warrant, okay? But in this case, each bond had a warrant, okay? They should have done a better job calling that out. So now they want us to use that information here to come up with this proportional method allocation, right? So we have $10 million of cash, right, that's coming in. And again, our job is going to figure out how much of that cash will go to warrants, how much will go to the bonds. Now they tell us that the bonds had a face of 10 million, but the market value associated with those bonds was 99. So of the 10 million, only 9,900,000 is attributable to the bonds. They told us, right, that the warrants had a market value of 30. So that market value of 30 times the 10,000 warrants, and again, I kind of had to make a leap a little bit to understand that each bond, because it was 10,000 bonds and each bond must have had one warrant attached to it, they could have more than that, was 300,000, 10 times the $30 per warrant. So I add those two amounts together, 10,200,000, okay, and then I assign, because remember the total cash that came in, let's just write that, the total cash that came in was what? 10 million. And using the proportional method, I'm going to want to figure out how much goes to the bonds, how much goes to the warrants here, right? Just using my little drawing here, right? And so what happens? Well, if I use this ratio here to figure out the total value associated with this issue, this amount was supposed to go to the bonds. I just come up with that ratio and I say, okay, the bonds then issued for $9,705, $705,882, right? Okay. And then for the warrants, they show me, I use their relative value here, and they show me that that math comes to 29411. 118. Okay, so I have now figured out how much goes to the warrants, how much goes to the bond using the proportional method, basically leveraging off the market value of each respective item, and then I allocated that purchase price. It's almost like back in whatever chapter it was where, remember, we had land and we issued the land, we bought land that had a building, and we had to allocate how much of the purchase price went to the land, how much went to the building. We used the relative appraised values. Same kind of thing here that we're doing here, allocating the purchase price between the warrants and the bonds. Okay, good. Now we come over, and when we do the journal entry on the next slide, we said, okay, that's a little hard to do, go back and forth, that much was for the bonds. So we say, well, of the cash we got, $9,705,882 was for the bonds. The bonds had a face of 10. So these bonds issued for less than face. Difference is going to be the discount. And then we said that what? We said that the bond, that the 294,118 that we attributed to the warrants, right? That much cash was attributed to the warrants. That's credited to an account called paid in capital warrants. Now, if you add, 9705 and what? 294,118, you'll get the $10 million cash that went in. So you could have turn this into a compound entry where you just simply would have included that credit up there. Okay, good. So that's the way that works. This question's a little bit not as clear. This example is not as clear. It's just a coincidence that the 10 million cash came in was the face of the bond. That's frequently not the case. You would have to, don't try to memorize, the discount is the same as the paid in capital on warrants. That's rarely the case. You would have to sit here and you would have to go through this idea of allocating the market price to the two items, add that market price together, that becomes your base, and then you allocate the total cash paid based on the proportion that each one made up of the total market price. Okay, good. Now, let's say a little bit later, they exercised the warrants and they pulled out of the sky somewhere. In this example, sorry, it's a little frustrating, that each warrant could be exercised for $25 cash. I didn't see that in the initial explanation of this case. But let's say that when I give you my warrant from my stock that I tore off of my stock, right? To buy, that I tore off of my bond, I tore that off the bond, and now I'm giving you the warrant, and I also have to give you $25 cash. I give you the warrant, I give you the cash, you're going to issue the stock to me, right? Okay, so they say that, the people that were exercising the warrants had to give me $25 cash for warrant. All of the warrants are being exercised, so we debit the cash for $250, we debit the paid in capital stock warrants, since all 10,000 are being redeemed, and that would completely eliminate the paid in capital stock warrants account. We would credit the common stock at par, and then we credit the paid in capital in excess of par for the difference between the cash and the value of the warrants and the par value of the stock. If all the warrants expire, then you simply debit APIC warrants and credit regular APIC, because pay APIC common stock, because now you're simply saying, hey, there was some value that came in. That 10 million, we assigned 294,118. That value came in, but now there's no more the period, because usually they put a period of time for the exercise of warrants. That period of time has expired, so now we're just treating that as an additional paid in capital. Okay? All right, good. And that's just that part right there. Good. All right, let's go ahead then. And, there's a couple slides with the incremental method, guys. Go ahead and look at that. I think it's a little bit of a clunky way, lumpy way of doing how you deal with stock warrants, and so I'm not going to test you on that. Again, what we talked about just there was example of detachable, so we had to account for the warrants separately from the debt. If it's non-detachable, then basically you're going to treat that just how we did the convertible bonds. You don't have to allocate any amount of the proceeds on issuance to the warrants. It all goes to the debt, and then you simply wait for them to exercise that and create your paid-in capital and issuance of your common stock for whatever cash they have to give you at the time that they exercise those warrants. Okay? All right, and then just a couple of, I guess, interesting comments again about the preemptive right, etc., that you may have, and those could be evidenced in the form of warrants if you have a preemptive right. Okay, good. Let's go ahead, guys, and take I think that's a good breaking point for us. So if you want to take a quick break, you can go ahead and hit pause. If you feel that you don't want to take a break now, just go ahead and let this roll, and we'll get into the next section, okay? Okay, let's go ahead and continue on now, and let's take a look at how we're going to account for stock compensation plans. Now, basically, this is an area that had some amount of controversy back in the 90s, early 90s, mid 90s, where in the past, companies didn't have to record any compensation expense associated with issuing stock options to their employees. What they would do is they would issue the option price below the market value of the stock, and as long as they did that, they didn't have to recognize any compensation expense. So FASB took a look at that and said, you know, we really can't have companies determining their accounting for issuance of stock compensation, like stock options, based on the price that they set the option at. They could avoid having to account for it a certain way based on the option price. So they came in and they said the options really have value. So what we're going to do is we're going to require companies to go ahead and put a value on the option at the time that they issue the option, and that's going to generate some compensation expense over time as the employee is working hard to make sure that the options vest for them. That has benefit to the company. That should be expensed in the over the period of the vesting using and recognized as compensation expense. Well, there's a lot of controversy around that because companies want to be able to issue these options for these various reasons that you see, and they'd rather not have to record the expense and report, as you can see here, the significant amount of compensation expense associated with things like these options and whatnot. Okay, so basically that was the case where there was controversy and back and forth, and FASB was sort of stopped from issuing the standard. And then there ended up being some scandal associated with the way companies were handling their options. So finally, took a while, I think it was the early 2000s finally, when FASB finally got their way and were able to take the fair value approach, in which they were going to require companies to determine the fair value of the options. And they say using an option pricing model, and the one that is generally accepted now, or commonly accepted, is something called the Black-Scholes model, and that Black-Scholes model is widely used, and it is used to give value to the options. Okay, so once we get to that point and we know that the option has value at the time that it is granted, then we can start to recognize the compensation expense over time, the value associated with those options. And so we're going to have a simultaneous recognition of some compensation expense, which is of course on the income statement, but then we will also at the same time Same time, see an effect on stockholders' equity. And then, of course, when the employees eventually exercise those options, then, of course, we will have a stockholders' equity event as the stock gets issued. Okay, so let's just go ahead and take a look at how we're going to recognize the amount of the compensation expense, and then how we're going to allocate that to the various accounting periods, where again, employees are working really hard and trying to make sure that those options vest. Okay, so let's look at this example. And guys, I apologize that they make some of these examples a little overly dense, I think, but I think we can work with these. Okay, so on November 1st, 2019, the stockholders of Chen Company approved a plan that grants the company's 5 executives option to purchase 2,000 shares of each company, 2,000 shares each of the company's $1 par value common stock. The company grants the option on January 1st, 2020. The executives may exercise the option at any time within the next 10 years. The option price per share is $60, and the market price of the stock at the date of grant is $70. Okay, so this option, is already a good deal. But we still would have to come up with what we perceive to be the market value of the options using some model. And they tell us, and I might have misspelled Black-Scholes earlier, but they tell us that by applying, using the fair value method, computes total compensation expense by applying this Black-Scholes model, and so then they go ahead and they tell us, to keep this illustration simple, we just go ahead and we get the value of these options. And guys, that's kind of how it would be. I mean, the accountant isn't the one that has to, figure out the value. Generally, that's provided through folks that have, knowledge of this Black-Scholes model and how to use it and whatnot. Okay, so we come over and we take a look now at this next slide and assume the expected period of benefit is 2 years. Okay, I don't know, seems a little arbitrary to me. I mean, they could be exercising this benefit over 10 years. They're saying the expected period of benefit is 2 years. I'm thinking, if I was looking at this, my question would be, well, how long before they vest on this, right? And if they vest on it immediately, I don't know that the benefit for a 10-year open option would only be 2 years, because maybe I'm working harder beyond those 2 years to keep the price of the stock going up. Price of the stock keeps going up, and I've got this option price that's down here. I'm accruing more and more benefit on that. So anyway, they're giving us 2 years here to keep this example simple, I think. And so since the expected period of benefit is 2 years, and we have what? We have this $220,000 value that we gave to the options. We simply take that $220,000 divided by 2, and we take compensation expense in each of those 2 years, allocating it over that sort of arbitrary in this problem thrown out as 2 years of benefit. Okay, income statement, stockholders' equity, the balance sheet here. Stockholders' equity, we credit paid in capital stock options. Okay, so what's going to happen? Now those stock options are sitting there, and at some point the employees would go ahead and probably exercise those options. You can kind of see when people exercise their options in a startup company. I've heard stories, I guess, I haven't seen it myself, but I've heard stories where, first there's nothing but, junky cars parked in front of the building, and then all of a sudden you drive by there and you see nothing but Teslas in the parking lot. That means what? Finally, the option vested, and people went ahead and exercised this nice low stock option price, and then were able to, sell the stock back on the open market, or maybe they sold the options. for a higher price, and they got all this cash coming in, and the first thing everybody does is go buy Tesla, right? Okay, so anyway, when they exercise the option, okay, they're going to have to pay that option price, and they say 2,000 of the 10,000 options were exercised, so that option price, okay, 2,000 out of the 10,000 means that what, 20% of that total that was in the paid-in capital options is coming out because they're being exercised. And then we're going to go ahead and issue the common stock at par, and the difference here is going to go over to the paid-in capital in excess of par. And I'm just checking that 220 number just to make sure we're comfortable. 220 was the total amount that went into APIC, 110 and 110. That total 220 went into APIC, and so if we've exercised 20% of the options, we're going to take 20% of that total 220 that's sitting in APIC options. The cash came in, issued the common stock at par to make the journal entry balance here. We go ahead and credit that additional amount to paid-in capital in excess of par, right? Now, what happens? A little bit later, in 2030, I don't know how little bit later that is, 10 years later, the stock option options expire. If they expire unexercised, any amount that hasn't been exercised up until that point, we go ahead and we debit the paid-in capital, and we credit stock options, and we credit the paid-in capital expired options. But I don't know, when I look at this example, I'm like, well, what the heck happened? You mean to tell me that the stock price just sat there at that price that it was, 8 years ago, and it hasn't increased at all, and the options just expired? I don't know. I find that a little weird. What happened? So anyway, these examples don't have to be realistic. They just need to be such that you understand the accounting. Okay? Okay, good. Now, you take a look, and of course, you'd have to disclose various things, including, as you can see down there, how you estimated the fair value, and then the cash flow effects. All right, good. Let's take a look at our earnings per share calculations, okay? And we're going to start out with the basic or primary earnings per share discussion, pretty straightforward. And then finally, we'll end up with how to do the dilutive shares. And as I mentioned, that does get a little rules-based, but we'll be okay once we look at those and kind of practice with them when we put up the practice midterm a little. The midterm's there, but when I get a chance to go ahead and sort of show you how that's going to work in our practice midterm. Okay, all right, good. So let's go ahead and let's take a look. And companies need to show obviously their net income. You've known that, but they are also going to have to report on the income statement the earnings per share. Okay, so when they report that, they not only report the earnings per share from continuing operations, but as we learned in 1A, if you have a discontinued operation, of course, you have to report your gain or loss from discontinued operations, and then you would have to show per share amounts for discontinued operations. And then, of course, discontinued operation is, if it's a gain, it's added. If it's a loss, it's subtracted from, and this was considered a loss here, subtracted from income from continuing operations. Difference is net income, and you have to report that earnings per share for your net income. So you really have three numbers, assuming you have a discontinued operation, that you have to report for your earnings per share. Now, as we go through this discussion, we're going to see that you could have a simple capital structure, and then you could have a complex capital structure in which there's potential where you have securities that could potentially be converted into common stock, and they're going to have to report something called dilutive earnings per share. Now, it's very important. I'm going to keep repeating this. You only report the effect of dilutive conversions. If you have a conversion that somehow increases your earnings per share above the primary, you do not report that. So we're only looking for the worst case scenario. We're only looking for dilutive shares when we get to that, okay? But before we get into the dilutive, the more complex structure that could have dilutive shares, let's go ahead and just take a look at our basic, okay? And our basic is going to be our net income. And if we have preferred stock, we would have to subtract any preferred dividends. And remember when we talked about dividends, if those dividends accumulate and they're in arrears, we have to subtract them whether the company declares or pays them or not, okay? And so we would go ahead and subtract those from net income, and then we divide that by something called the weighted average number of shares outstanding, okay? Now, we've seen this, okay, how you calculate the earnings per share on the common, okay? What we haven't talked about is, well, what is the way that you're going to calculate the weighted average number of shares outstanding, okay? So let's just go ahead and let's take a look at this example that's going to allow us to calculate the weighted number of shares outstanding, because you have to use that in the calculation. Okay, so you come over and we have this situation with our shares, and this is before we're calculating the weighted average. We have a beginning balance of shares. We issued 30,000 shares on April 1st. Then we purchased out of treasury stock 39,000 shares. Okay, then we went ahead and issued 60,000 more shares, and then we have the ending balance at December 31st. So what we need to do here is figure out, well, what is the weighted average? And it's pretty straightforward in an example like this, where there is no issuance of stock dividend or stock splits. It's pretty straightforward. So this example didn't have any of that. So you can see, pretty straightforward. The 90,000 shares, right? We're sitting there at the beginning until April 1st. So that's 3 months. So we wait that 90,000 for 3 months. And I'm going to keep flipping back and forth, guys. Here we issued 30,000 more shares. So that brought us up to 120. And that was the case for April, May, June, July for 4 months. So we take the 120. What did I do wrong? April, May, June. I counted July wrong. Okay, be careful with that. Easy mistake to make. I just made it. Okay, and so what happens? That was only 3 months because I shouldn't have counted July. Then we were July to November, July, August, September, October. Apparently, I'm not good with months. That's only 4 months. Okay. And so we multiply that times the 4 months after we hit, and that brought the number down because those were treasury stocks that we had reacquired. So that, let's just look back. We took that 120 minus the 39,000 treasury shares. That brought us down to the 81,000. And then we issued what? 60,000 more shares. So that then brought us up to the 140, but that was only the case for November, 141. That was only the case for November and December. So we have our weighted average shares. We would then divide that by, again, our net income minus the preferred dividends, and that would give me my primary earnings per share. And that's basically, in this example, assuming there were no stock splits, stock dividends. Now, if you have stock dividend, if you have stock split, then you're going to have to treat those retroactively. You're going to have to pretend like they had happened at the beginning of the year, even though the stock dividend, stock split maybe didn't happen until May. You pretend like it happened at the beginning of the year. Okay, so remember, when we start getting into these earnings per share calculations, we start getting into where accountants finally get to pretend as they go ahead and make some decisions about how we need to account for certain things. Okay, so we come over and let's take another example now where we had beginning shares 100,000. We issued 20,000 shares. Then we issued additional shares in a stock dividend, okay? And this stock dividend was at 50%. stock dividend, so we issued an additional 60,000 shares. Now that stock dividend here is going to complicate this calculation a little bit because we're going to have to treat that retroactively, and you'll see that on the next slide. And then we issued, 30,000 more shares. So you come over and you take a look and look what they do. Notice it was a 50% stock dividend, and that didn't happen until, what did they tell us? Until June 1st. But notice we apply that 50% stock dividend as though it had already been issued at the beginning of the year. So we start out saying, hey, we don't have 100,000 shares that were outstanding from January and February for the 2 months up till March. We had 150,000 shares because we pretend that 50% stock dividend had already been issued on those shares, right? Then we go, and if you look at the problem here, they tell us, well, when you issue those 20,000 shares, you didn't issue 20,000 shares, you issued 30,000 shares, because again, we apply the stock dividend as though it had already happened at the beginning of the year. At every time we issued an additional shares, we issued the stock dividend on those additional shares that we issued as well. So it's not 30,000, it's 20,000 times 1.5. It is 30,000. Well, if you take what? If you take the 100 and you issue those 20,000 additional shares and you multiply that 1.5, 120 times 1.5 is 180,000, or you could look at it 150 plus the additional 30,000 shares got us up to 180. And that 180 then what? Now you have gone ahead and you've applied the stock dividend to everything that happened before the stock dividend, and so you're sitting there at this 180. And then, of course, when you finally issue additional shares of whatever it was, 30,000, that brings me up to the 210 at the end of the year, and that sits there for the 2 months. You go ahead, you apply your weighting, okay, for however many months, and that gives me my weighted average, okay? So, important takeaway from this example, you got to apply stock dividend, stock split to the beginning of the period as though it had already occurred, right? Okay? Okay, good. So, now we've got our weighted average shares calculation. We will use those weighted average shares in calculating my primary. We will use the weighted average in calculating my diluted, but now my diluted is going to have the potential where we're not only going to have impact on the numerator, but we could have impact on the denominator, because we assume that convertible bonds were converted to stock, that convertible preferred was converted to common stock, that any outstanding warrants were exercised. If there were options outstanding, those were exercised, etc. Okay, so now we're going to get a chance to start to pretend a little bit, and so you're going to see that gets to be a good fun opportunity for us to use our imagination for a change. I always tell my accounting students in intro, don't use your imagination unless I tell you to. Well, at this point in time, I'm telling you, use your imagination for some of these, and we're going to see how that's going to work. Okay, so let's go ahead and let's take a look. And again, the nature of the items that we need to consider in calculating our diluted earnings per share is what would happen if, say, convertible bonds or convertible preferred stock were converted into common stock. What would happen if the options or the warrants were exercised? And that's pretty much what we're going to focus on. And again, the important thing, well, it's all important and it's kind of rules based as to how we do this, but don't forget, because it's an easy mistake to make, only report those conversions that are dilutive, that bring the earnings per share below the primary or basic earnings per share. Okay, so the way that's going to work is kind of becomes a mathematical consideration, and that what you're going to do is you're going to have the conversion affect the numerator, and the numerator effect could cause in most cases it will cause the net income to increase, but it will cause the denominator, the shares outstanding that we're using, to increase. And so just mathematically speaking, that could have the result be where the earnings per share, after you consider these dilutive securities, if it brings it up above the primary earnings per share, we won't report it. And it's not even like you can net out the dilutive effect of two different things. Each conversion needs to be evaluated separately to see if it has an anti-dilutive effect. And if it does, you throw that one off to the side and you only include those that have a dilutive effect, bring the earnings per share amount below the primary earnings per share, and that's all you report. Okay, good. So let's start to take a look then. I get so excited when I'm talking about this stuff, I don't know where to put my clicker. Okay, so let's just go ahead and let's take a look at what we call the if converted method. And this is really used for convertible bonds, right? Remember we said we had the example where you have a bond and you convert it from a bond to stock, common stock, and we said, hey, the reason a company might do this is maybe the bond interest is high and they want to bring that, eliminate that bond interest, and so they're going to go ahead and convert those bonds into stock. Or maybe the bondholders are excited about the stock prices going up and interest rates aren't that great, and so they're going to want to go ahead and convert those bonds into stock. Now, obviously, if you do that, you're going to have more shares that are going to be outstanding, but you're going to get rid of interest as part of your expenses and calculation of your net income. That brings your net income up. That now could be anti-dilutive, and if that's the case, we won't report it. If it's dilutive, then we will. Okay, so you go over, and guys, I wanted to eliminate these examples. Okay, as I've said a couple times, I feel like the book just goes a little overboard with some of that fact pattern there, and I meant to delete these for you, and I may have deleted them in the slide deck I put up for you. If not, just go past these. I feel, I don't mind leaving an example in, but sometimes if the example does more harm than good, I don't like it. Okay, so let's just go to this example that I borrowed from some other material, because I think it does two things. One, it illustrates well the if converted method, and it does a good job of illustrating the anti-dilutive considerations. Okay, so let's just look at this one, and I'm going to go ahead and just kind of highlight it for you as we go. Okay, because I think it's a short and kind of a good example that will be helpful for you. So I just want to take the little time here to read it together, look at it. Okay, so let's take a look. The X company has outstanding 100,000 shares of common stock and 500,000 and 6% bonds that can be convertible into 10 shares for each $1,000 bond. And net income for the period is 100,000, and we're going to go ahead and compute the potentially dilutive earnings per share. They probably should have said, and they talk about a tax rate here of 34%. Okay, so you come in, and what happens? Well, we have 500 bonds, and I'm going to go ahead and switch to pen here now. I think Microsoft could do a better job of giving me my pen palette, but they don't listen to me. So we have what? We have $500,000 worth of bonds, they tell us. And they tell us that what? Each bond is a $1,000 bond. So we've got what? We've got the 500 bonds. Okay, we've got the 500 bonds, and then they tell us that each bond can be converted into 10 shares of stock. Okay, so if you take those 500 bonds times the 10 shares of stock, we would end up issuing what, 5,000 additional shares of stock for 105,000 shares that would then be outstanding, right? And that's going to affect obviously my denominator in this example. Okay, so let's go ahead and continue this example. And so we've got these 5,000 additional shares that would have been issued if the conversion had been exercised there, right? Now we had net income of 100,000, but now we have to consider, well, what's the effect of if the bonds were converted, and we always assume the conversion happened at the beginning of the year. If the bonds were converted at the beginning of the year, then there would be no interest expense. So we basically figure out the interest expense on those bonds, which they were 6% bonds, 500,000. But if we have interest expense, we would have shielded a certain amount of income from tax. But if we don't have that expense anymore, then our savings is not the entire amount of the interest here, what, 30,000. It would have to be what? It would have to be net of the tax now that we would have to pay on that additional income, since we didn't have the interest expense anymore. So they told us the tax rate was 34%. So the 34% minus 1 means that, after tax, we would be, having 66% of the 30,000 savings, right? So we go ahead and we add that, I guess comes to 19,800. We add that back to our net income, right? Because now we didn't have to pay that interest expense, but again, we do that net of tax. That means my net income, and again, get to pretend my net income would have been 119,800. I divide that now by what? The 105 shares that would have been outstanding had I converted those bonds to stock. And that now gives me a diluted, it's actually anti-dilutive, a potentially dilutive earnings per share of $1.14. But my primary earnings per share would have been my net income divided by the 100,000 shares, right, that were outstanding. That would have only been $1 per share. Therefore, I would not consider that in calculating my diluted earnings per share, because it is anti-dilutive. And again, when you look at the potentially dilutive effects, you look at them individually, one at a time. And if any one is anti-dilutive, you throw it out of the calculation. Okay? Only can include dilutive securities. All right? Okay, now that's if it's a bond in that example. What if we have convertible preferred stock? Okay? And the big difference here now is going to be there'll be an effect on the numerator and the denominator, but now what's going to happen is, rather than subtracting the preferred dividends from our net income, we're just going to not make that subtraction, leave those preferred dividends in the net income, don't subtract them off, and then divide by the amount of shares that would be outstanding, and see again if that is dilutive, then we would include it. Okay, let's look at the example. I think you'll see that this is pretty easy. So what happens? We have this illustration here. Barclay Company issued 40,000 shares of 6% convertible cumulative preferred stock, $100 par value. Each share is convertible into 5 shares of common stock. Net income for 2020 was $1.2 million. There were 600,000 common shares outstanding during 2020. There are no changes during 2020 in the number of common or preferred shares outstanding. Fine. That's fine. So we don't have to worry about, calculating a weighted average. because there was nothing else that had happened during the year. I'm just going to consider, well, what happens if these had been converted, and we just assume that happened at the beginning of the year. Okay, so our primary, our basic earnings per share, of course, would have been our income minus the preferred dividend. Remember from our last chapter, we take our shares times their par times whatever the interest rate is on that. That's the preferred dividend. We subtract that, and then we have the weighted average shares that they gave me, 600,000. So my primary is 160. That 160 is going to sit there as a threshold to determine whether my calculation now of the potentially dilutive shares is actually dilutive or anti-dilutive. So I come over, and this gets a little funny the way they're doing this. I mean, they subtract, they show what it was for the basic by subtracting the preferred dividend, but you wouldn't subtract the preferred dividend if those shares had been converted to common. So we just pick up the net income without subtracting the preferred dividend, right? And then we would have had, what, an extra 200,000 shares outstanding because it was 40,000 shares of preferred, but those were good for, if they were converted, for 5 shares each of common. So we would have had an additional 200,000 shares. You take that 1.2 divided by 800,000, we come up with 150. Now, again, you should calculate, if you have multiple potentially dilutive conversions, you need to look at each one of them individually. So that's really what they did here. They said, well, look, if you increase the net income by 240 and you increase the shares by 200,000, that has an effect on earnings per share of $1.20. And since that's less than 160, mathematically, we know that that had a dilutive effect, and we can then see it on the total. It is dilutive because it's less than the primary. But you have to evaluate each conversion separately like that. Okay, good. Now you come over and you take a look at option B here now, and with option B, what happened was we can only convert those into 3 shares. Well, if that's the case, instead of the denominator going up 200,000, it only goes up 120. If that's the case, then notice that add back of the net income for the preferred dividends has an anti-dilutive effect. It actually increases my earnings per share above the primary. In that case, I would not report the it's not dilutive, the anti-dilutive impact from the conversion of those preferred stock. Okay, good. Let's go ahead then and let's take a look what happens if I'm considering the potential dilution. Actually, it would be a dilution caused by options and warrants. But what they asked me to do in US GAAP is they say, hey, we want you to use something called the treasury stock method. And what the treasury stock method says, when those options and warrants, remember, were exercised, generally, they gave me the warrant, they gave me the option, and they gave me some cash, right? Remember that? Okay, a little while ago. What happens? That extra cash that comes in has to then be turned around and used to repurchase my stock on the open market. That's called treasury stock. And then the dilutive effect is simply going to be the number of shares that are left that couldn't be repurchased with the additional cash that came in. And that will be how I will calculate the diluted earnings per share. Okay, so let's just take a look. And we have the situation of this is Zambrano Company, and they give us the net income, and they say the potentially dilutive shares outstanding were 1,000 options issued during 2019, each exercisable for 1 share at $8. So they're going to give me the option up, and then they're going to go ahead and give me the $8. So more money's coming in. None have been exercised, and 10,000 shares of common stock were outstanding during 2020. The average market price for the stock during 2020 was $20. Well, let's go ahead and see what's going to happen. We're going to have to calculate that diluted, and they say compute diluted earnings per share. Assume 1,000 shares were issued, 1,000 options, I should say, were issued on October 1st, because we're going to see that we will do a partial year accounting if those options are issued during the year. Okay, but let's look at the choice A, or situation A right now, and what happens. It's 1,000 options. If they exercise the options, they got to give me $8, right? To exercise the option, they have to give me $8. So what happens? I should get 8,000 if the problem said the market price was what? $20 per share. That means that I could take that $8,000, go out into the open market and reacquire what? 400 shares of my stock back that had been issued as a result of the exercise of the options. So net, there'd only be 600 shares that would actually be additional issued shares net of the amount that I had reacquired. So if that's the case, then I do what? And they show plus nothing here. There's no more income that's generated by this. It's simply whatever my net income was, and then what? Plus the additional shares that would have been issued after I exhausted the funds that came in from the exercise of the option. So I would have 10,600 additional shares. That has to be it has to be dilutive, not anti-dilutive. Has to be dilutive because my numerator stayed the same, but the number of shares that were outstanding went up. Okay, and then all that happens in case B here is they go ahead and they assume, well, look, if the options hadn't been issued until October, then this dilution couldn't have occurred until October and would have only affected the earnings per share for October, November, December, 3 months. And so we simply take that 600 additional shares that would have been issued net of the additional proceeds that came in and multiply that times 3/12. Okay, and again, that's going to be dilutive because, again, you're increasing not as much, but you're increasing the denominator and you're not doing anything with the numerator. Okay, and then there are, again, earnings per share presentation. Okay, and as we've mentioned, income from discontinued operations, from continuing operations, and then from discontinued operations, they are saying twice here for some reason, and then net income. Okay, and per share amounts for a discontinued operation should be presented on the face of the income statement or in the notes. Okay, and I think we said all that already. Okay, guys, excellent, good work. Stay tuned for the practice midterm lecture, which should be coming up shortly. Okay, all right, guys, have a good study time. All right, we'll talk to you soon.